All right, good evening, everybody. Thanks for joining me tonight. Hope you guys are doing well. So, just to get started, we'll first just kind of dive in to SPX, what it ended up doing this week, and then we'll dive into the challenge, where we're at with it, and then some trade ideas going into the end of the month, right? Because we're about to end the challenge here within the last week. And then we'll get set up for the next challenge starting in February and see if it can't turn out a bit better than how this one's working out for us right now. So just to get started with SPX here. All right, let's zoom in a little bit more. Overall, ended up being a bullish week, right? We ended up seeing that continuation and bounce off of the 10-period simple, so that's continuing to hold support for us. As some of you guys might know, for my simpler trading people out there, you hear me talk about this quite a bit with SPX, how the 10-period simple is usually the main level of support when it's in a bullish trend. Every now and then it will go down and test the 30 as well, but as long as it can maintain ideally the 10, if not certainly the 30-period simple, to me it's still in a bullish trend. We talked about some last week that if it, broke the 30-period simple, that's when I personally start to look at potential hedge trades for the account and things like that. But we're still holding that level. Really, we're holding the 10-period simple, and we've continued to bounce up today, right? We ended up opening a bit lower, ended up trading right down, still holding support there. We held some intraday levels of support on the hourly chart, and then we bounced back up into the close, and we actually formed a bullish divergent bar. So though I don't typically take these trades on a Friday, this to me certainly bodes well for SPX continuing in the trend to the upside, because we're holding support, right? We're forming the bullish divergent bar. We have momentum that's bullish with room to move higher. And we have a bullish signal on the compound breakout tool. So all of that is continuing to point to the upside for SPX, which to me means that we could very well see it continue to the upside going into the end of the month. So that's what I am at least playing towards at this time. Which, to dive into our challenge, right? We know we have a trade on SPY. So similar situation here. It didn't technically close in a bullish divergent bar. So, SPY is the ETF of the S&P. So it doesn't 100% track it in the same way, but it's relatively close. You're not going to see SPX with a huge up day and SPY with a huge down day, right? They certainly match up with the pattern most of the time. So even though it didn't quite get the bullish divergent bar today on SPY, it still is holding support overall, still has the bullish momentum with room to move higher, still has the bullish signal on the compound breakout tool, and is still pointed to the upside. So if the SPX is poised to move higher overall, more than likely SPY will too going into the end of the month too. So what that means is, right, even though we opened lower and went down today on our SPY trade, overall we're looking for it to bounce back up and ideally continue to the upside, right? Continue in this bullish pattern. So what we opened to prep for that was the 387, the 390, 391 broken wing butterfly. So basically what this is it allows for that bullish sentiment to the upside. Ideally, if we got to 390 going into the end of the week, that would be where our max profit potential is, because no matter what, a butterfly, right, is composed of a debit spread and a credit spread. In the case of the broken wing butterfly, we have a 3-point width debit spread and we have a 1-point width credit spread. So if we're at 390, that means we're getting the full profit on the debit spread and the full profit on the credit spread. The benefit of the broken wing butterfly, though, is the forgiveness factor if the S&P were really to take off into the end of the month, right? If it was really to see a strong bounce and turn bullish and kind of move higher, then it gives that added benefit of the price moving to where the strikes are completely in the money. So like something like, 391.50, 392, anything above 391 really. And still allowing for a profit potential, because the credit spread is only comprised of $1 and our debit spread's comprised of $3. So when we take into consideration the 1 point width here plus our cost basis, overall we still are able to lock in some sort of profit potential, which in turn the idea behind this SPY trade that we had open both for this week and the one that we pushed out again for next week is to help cover DKNG and CSCO, which at the end of this week they both ended up expiring worthless. So some of you guys I know ended up getting out of these earlier. So you might have been able to protect a bit more capital. I just decided to let them go into the end of the week and see if we can't make it up from there. So let's dive into both of those trades based off the technicals first. First is DKNG. So here, right, we opened based off of the bullish divergent bar. We had the bullish signal in the compound breakout tool, which was still valid. We had the switch in the ATR trailing stop, bullish momentum. So our signal for jumping in looked good, and it followed through technically with the higher high. So the signal satisfied itself. And I had some of you guys mention like, yeah, I decided to go ahead and take my profits early. And if you did, outstanding, because then you're still doing pretty well on the challenge if you were able to do that, because you offset the loss and you actually took a profit on top of it. At the time, whenever I was watching this throughout the day, it was close to our good till cancel, and I had to step away. So I thought, from the chart, so I thought, okay, it's close. We'll probably get a hit. I'll get the notification, if not, everything still looks good and bullish. So we'll hold on to it, sort of thing. And so didn't end up getting that fill. The price pulled back into the close that day. Overall, though, at the time, right, let's take a step back in time. So at the time going into the close that day, Bollinger Bands were still opening up overall. We still had bullish momentum. We still had the bullish signal on the compound breakout tool. And with that recent switch in the ATR trailing stop and the 10 getting ready to cross about the 30, this to me still looked like a good bullish sign. I knew we might pull back a little bit, right? We've technically been printing back-to-back divergent bars, so we still might be in a little bit of consolidation. But I still liked the overall signal to the upside. So the next day we certainly pulled back, right? We went right back down to test support. It held, formed another bullish divergent bar. So this told me once again, okay, you have time on the trade. You're getting another bullish signal. Let's see if we can hold, maybe go back up and retest the highs. And if so, we'll adjust our order lower, right? If the good till cancel doesn't fill this time, and we'll just take the smaller profit. We'll protect capital and look to do it that way. And so that means I need to give it 3 bars time for it to work out. So didn't work out the next bar, right? Instead, we went down, tested support again. It was still holding. But this is when we did start to cancel out of our bullish signal. And then the next 2 bars, still holding support, right? Close, but didn't follow through technically on the bullish signal here. And then that pullback signal immediately satisfied itself and canceled back out again. Now, what was weighing on us here is the Bollinger Band started to turn flat again. So that was our first sign that we might not get the strong bounce back up. Momentum at this point is also starting to pull back. So even though the bars are above the 0 line, it's starting to consolidate. Probably should have been my second clue. And then, of course, we canceled out and are printing more consolidating signal on the compound breakout tool, right? It's not the strong bullish signal anymore. But I still liked that it was holding support on the 10-period simple. And because technically, right, Thursday was our last trading day, there wasn't that much value left in the spread either way. That's why I decided to hold on to it to see, okay, maybe we'll get the bounce on the 4th day if things want to go up today. And in turn, maybe that's when it will follow through, or at least, we can close it out for break even, or, maybe a smaller loss than what it was showing. Instead, though, DKNG ended up pulling back down again to test the 30, really staying in a very narrow range of consolidation between, I'd say, about 51 to 54.50, roughly in that range there. And things still remain flat. So what we could look to do if we wanted to make a DKNG within the next week is take a more theta decay friendly style trade, something like a credit spread or an unbalanced fly into next week. That way, right, if we do it more on the put side, because it's a credit spread, is actually a bullish sentiment when it's on the put side. So it plays to the bullish sentiment overall of this trying to go back into a bullish trend to move higher. But it also plays with the consolidation that we are certainly currently experiencing here. So let's go ahead and price it out. I'm going to do this on Tastyworks. It's just a lot easier to, I think, see the strikes compared to Thinkorswim on their platform. So I'm going to pull it up over here. And of course, this is going to be for next week's expiration, right? So it's priced very narrowly. There's not going to be a whole lot of premium here. If we did the unbalanced butterfly, let's just price it out and see if it's something that makes sense. 51, well, certainly 50 would be a good level, but I doubt we're going to get premium down there. 50, of course, because it's a psychological level, there's a lot of open interest. So there's a good probability that that will still hold support. But 51 I like because it is by the 30 period simple, which, since we've traded above it, has been holding out nicely. So let's start there. For an unbalanced butterfly, it's a standard butterfly, so it's the one side of the debit spread, one side of the credit spread. But because it's unbalanced, it actually has an extra contract on the credit spread side of the trade. So it's basically 2 contracts of a credit spread and 1 contract of a debit spread. Typically, when you do it on the credit spread side like that, you end up with an overall net credit. And the idea behind this trade is as long as it can maintain out of the money, the credit that you receive is your locked-in profit. If the price moves down to your pinstripe, that's the forgiving factor in this trade, and it allows you the max profit potential of the width of the spread, which in this case is 50 cents, plus the credit you received, which is 15. So in this case, it'd be 65 cents per contract. And then the risk is if you really start to dip below your short strike, right? If we really start to tumble on DKNG, if we did go down to 50 in this case, then we need to be okay with the max loss of 35 cents. So, overall, certainly not a bad risk versus reward. Even in the challenge account, we could look to do a couple contracts if this makes sense. We would have to worry, though, about the cost of commission that will eat up on this trade a little bit because it is 3 different legs that we're jumping into, right? And certainly if we did multiple contracts, that too would add up. But we could do something even like 3 contracts. That would be about a 45-cent credit on the capital cost, right? $45 credit on 3 contracts if it remains out of the money and we just let it expire worthless. It's a 195 max profit potential if we do go down to 51 and stall. And then the loss is about $1. So about a fifth of the account would be it. So that's one way we could look to manage it. The other way, right, would just be a strict put credit spread. If we go with something at the money, we could do a dollar width spread, which is a 46-cent credit, 54-cent risk. We could certainly look to do 2 contracts of that, make a 92 profit potential, 108 risk. That would cover our loss this week, right, which is at $88, and still actually allow us a small profit potential if it did completely expire worthless. So, hey, Capjack, sorry, I just saw your message there. New to options, completely understand. I have an idea, but don't know what theta decay. Is there any way? Yeah, so theta decay is the value that is created in these options due to the time that they have until expiration. So when I say theta decay, it's basically taking advantage of the options that are out of the money becoming worthless going into the expiration. So with a credit spread, when you open it up, right, something like this, for example, you're opening it for a net credit. So the idea is you want to close it for a smaller debit than the credit that you opened for, and that difference will be your profit. If you completely expire out of the money, meaning if DKNG trades, let's say, in the case of what we're looking at here, if it trades back up into 54, and that's where it closes into next week, then our strikes are completely out of the money. They're going to be worthless because they're completely out of the money. So the credit that we received is going to be our total locked-in profit. So that is what I mean by taking advantage of theta decay. And that's a great question. So thanks for asking it. So that's what we'd be looking at here for DKNG. And you can see why that benefits, right? Because if we see a strong bounce up, then we're definitely going to be out of the money on this. The further that it moves out of the money, right, the less likely that these strikes are going to go back in the money. That's why they're cheaper, which means they're getting closer to being worthless, and in turn would allow us to profit more quickly. But if DKNG just hangs out here, right, if it doesn't really see a strong bounce up, but our short strike, which is the one that we're selling to open this red one here, remains out of the money, then it will still be a profit that way as well. So, and then Rick, yeah, I would be looking at a put credit spread in this case. So that's what I would lean towards. And then Spine Chef, do you put on your trade depending on where the stock opens? Typically for entry, this is, to me would be a bit more of a management style trade. So in this case, right, I would definitely look at where it opens on Monday, because if we're not holding the 30 period simple, then first of all, there's no way I'm getting these strikes. And then second point, I would need to see how it trades on Monday in order to determine what kind of strategy I might want to put on at that point. Does it still make sense to do a credit spread? Or would I lean back towards a vertical spread, or maybe something called an iron fly, which is a combination of two credit spreads, one on the call side, one on the put side, where the short strike is the same strike. And then much like a butterfly, the idea is if the closing price ends up being right around your short strike, you'll benefit from both of these experiencing that theta decay, right? Both of them basically becoming worthless, and this credit becoming a profit. So if we move down, right, it might make sense to do a wide wing iron fly or something like that and take advantage of that choppy sideways movement. So we'll see what happens. But right now, given what I'm seeing going into the close Friday, I would probably in this case lean towards the straight put credit spread. And the reason why is I really liked the cost basis on the unbalanced fly. I just know because it's a 50-cent spread width though, the commission cost is going to eat us up a bit more because of how many contracts there are versus the credit we're receiving. And then a Scuba 30M, I use the simple moving averages. So I use the 10, the 30, and the 100. And when I first started at Simpler Trading, and John and I were comparing charts, we realized that his 8 and 21, I think is what we were looking at, is very similar to the 10 and 30. So it just kind of depends what your preference is. I've used the simple moving averages since I first started trading. So if you find that you get better trades and signals off of the EMAs, go with that. But I use the SMAs. That's just a creature of habit, I guess, more than anything. And then, no, then the strikes or delta, it depends on what style trade that I'm doing. So if I'm doing something like a long call or long put, ideally a 0.7 delta is what I like. And then with spreads, it really depends on my entry, if I'm looking for a certain level and things like that. And then Captain Jack. So in the Mastery account, I actually have an account. It's $5,000, and I only trade 25% of that account on opening new trades, and I will never go over 50% of that account between new trades and management trades. It kind of follows this rule that I have on how much I invest in my accounts overall, my 25% rule. So that means in reality, you're not really ever going to see me invest more than $2,500 in the trades. So if you want an account size of $2,500, knowing you're investing the full amount, potentially at one point, which we haven't done yet, you could certainly look to do that. And then every now and then I'll certainly post the trades for the $500 challenge in there. And sometimes I'll post trades for my main account as well if you want to follow those. But those can be a little bit more expensive. The majority of the trades, though, I open in the Mastery account. And then at the end of each month, I plan to pay myself with the profits that I make there. Ideally, right? So this month's profitable. So if we can keep it up into the end of the month, right? Knock on wood, then I'll pay myself at the end of it. And we'll start back with the 5,000 at the start of February. So that's what I'm looking at for DKNG. That might be one way to manage it. Keep in mind our SPY trade itself if we were to go up to 390 and stall there, could technically take care of the risk both on DKNG and CSCO. So, I'm not feeling forced to put on that put credit spread, but if we wanted to take care of that trade within the same symbol, right? Some people are kind of picky about doing that. To me, as long as the overall account's still up, I don't mind what symbol takes care of what loss where, right? A profit's a profit. But if you did want to, that's the strategy I'd be leaning towards. Let's talk about CSCO, right? This one also expired for a loss this week. So here was this one. You can see my order was still out there, so there's no point in that 'cause that's gone. But here was the signal that we took it off of. So once again, if we go back in time, I still like how this signal looked. Bollinger Bands were opening up. Momentum was building up from the zero line. Bullish signal on the compound breakout tool. We were in a daily squeeze, so that looked good that if this started to fire, or maybe potentially showed us a gap move, the squeeze could fire to the upside, give us that quick profit. That was my mindset behind it. And then, right, we technically followed through with a higher high. It was one of those barely there higher highs. The only clue that we had of this on the charts that we might see a bit of consolidation was the fact that we technically had back-to-back divergent bars prior. So, sometimes you can take off still from that. Other times you'll remain flat. This case, right, it barely followed through. It was barely a profit from my memory, right? Nowhere near the good till cancel. And then it came immediately back down and started to stall again. However, because we were still holding support, because everything was still bullish down here and there's a squeeze, that's why I felt inclined to hold. I was like, okay, even if it doesn't fire during the monthly expiration, there's still a good probability that after that, right, the market will turn back bullish again. It will get that extra pickup and it will continue to the upside, and in turn, CSCO might follow along with that. Excuse me, guys. So because of that, right, the market did see that turnaround. It bounced higher and moved overall to the upside, even though it pulled back a bit today. CSCO did not follow along with that, right? Instead, it continued to hold support, but then we started to cancel out of our bullish signal and actually turned into a pullback signal. Excuse me. Momentum started to reset. Bollinger Bands are flat. And then we made a bullish divergent bar yesterday. At this point, once again, is basically at a full loss. So I just was like, okay, maybe we'll get the immediate bounce back up. If not, certainly we have the SPY trade on to help take care of this. And of course, right, we opened lower on CSCO, still printing a squeeze, still trying to hold support. I do like that into the close we're still holding the 30. And I also like that Bollinger Bands aren't flaring open to the downside, so they're not anticipating the squeeze to fire lower, even though we still have pullback signals to say that this could test the ATR trailing stop around 43. But it didn't fire for us. So because our trade was too short dated, it's going to end up expiring worthless. But the signal still followed through for us, right? So both of our signals followed through technically, which is the good thing, right? Our technicals still worked out for us. It was just one, in the case of DKNG, we didn't modify the trade to try and lock in that profit a bit more quickly and protect capital. So that was, on me. If you were watching your accounts, hopefully you were able to do that, or at least learn from this for next time, right? And then CSCO, that one it wasn't going to work out. So I maybe should have looked at management, or at least reducing my risk a bit sooner on that trade. But like I said, when I see a squeeze, I try not to do that, because oftentimes I find that the squeeze still ends up allowing it to work out. So that's what I was waiting for there. Yeah, not a problem, Captain Jack. So that's what we're at with both of those. So both of those ended up being a loss. And then we have WBA, which still technically has a valid signal. So let's talk about that one. Scuba, no. So on this strategy that we mainly use, which is the overnight profit strategy, to me, on a daily chart, it's good to keep it shorter dated overall, because it usually allows for that bigger profit potential. So let me pull up WBA and we'll talk about it. And then we can dive into your question a bit more. But just to give you a short answer to that, what I found is doing the shorter dated expirations, when the move follows through, usually, ideally, right, when we've constructed the spread, it goes completely in the money. And so that value is added into the spread a lot more quickly because there's a lot less time for the market to move back against it, right? So because it's going closer into expiration, just like theta decay is occurring on the out of the money strikes where they're becoming worthless, the in the money strikes are gaining whatever value they should have compared to the underlying price, which means if our spread's completely in the money, it's gaining the value of that spread width, which in turn leads us to that max profit potential, which usually means our good till cancels hit, and then we lock in the profit. That's, for those of you who are in the mastery, right, that's what we saw with our PayPal trade today, right? We just let it go. The good till cancel was hit as the spread was going in the money, and it gave us the quick profit. So if you go out 45 days, the only issue with that is if you don't get a strong follow through on the move, right? Even if your spread does go completely in the money, it's 45 days out. So there's a lot more time for the price to technically go back against you. So it's not going to build in that profit potential as quickly. So usually you'll find yourself taking a smaller profit on the trade, if at all. Half the time, if you go that far out, the spread still might be around break even. So if you're looking though at a weekly time frame, then maybe going out 45 days makes sense because you want to give yourself at least 3 weeks, and you're just maybe giving yourself an extra week or two. So on the daily chart, if you're looking to give yourself an extra week, maybe that might make a bit more sense. But even then, depending on the symbols, sometimes I still find, I'm not getting as much of a profit as I would have done if I just went with this week's expiration, as long as it allows for the 3 days for it to work out. So on a lot of these symbols, right, I give it 3 days of time to work out. Case in point, WBA. Here we opened the trade based off the bullish divergent bar, hitting the 10-period simple and holding it as support. Bollinger Bands even today, right, are still opening up. So this is still a good sign ultimately for the bulls longer term. We had the bullish signal on the compound breakout tool. Momentum was pulling back a little bit, but everything else looked good here. Instead, right, we opened a little bit lower, tried to hold the 10-period simple, and then ended up closing below it. We printed a pullback signal, so this certainly makes me cautious between yesterday and today. But once again, I need to give this 3 bars to follow through with some sort of higher high, even if it's just a barely higher high. I need to give it 3 bars to see if I can't get back up there. So the next day it didn't work out. The second day, which was Friday, right, moved a little bit lower, but we ended up closing at the high, created a bullish divergent bar here. So that's a good sign that Monday, right, we might get that follow through where it's an immediate follow through on this one, and then it took us 3 bars to follow through on our original entry. I've seen that occur quite a bit, so I'm not too surprised when I see that setup try and print. Now here it didn't work out, right? That's kind of why I took this entry, because it was a similar situation. This one didn't follow through, so maybe it will happen again where it doesn't follow through. But the overall trend is still bullish. Even though momentum is pulling back some, the bars are still well above the 0 line, which adds to that strength. So that's why I'm still staying in it. Now, if we don't get the follow through on Monday, right, with the higher high to where it bounces up, I'm a lot less inclined to continue to hold this trade. So what I'll probably look to do, because we're in the 48.50 spread. So let me just pull this up on Tastyworks so it's easier to see. So here's the trade that we're in right now, right? So one thing that I could look to do if I still wanted to play for that potential bounce to the upside, thinking that we're not going to break above 50, is I could turn this into a butterfly by opening the credit spread side of the trade. So keeping it the same width, which is 2 points, would make it a standard butterfly. It's not really giving me much premium at this point, right? It's only about 10 cents, so it's not really adding too much back into the account, unfortunately. But if we did start to get a bounce and I still felt the need to protect capital, this might be the way to do it. The other thing to do is I could look to take the profit on the 50 strike, right, which is about a $16 profit, and then narrow the spread. So close it out and then move it up to, in this case, the only strike available is the 48.50. So that reduces the spread width. Ideally, right, if we take this action, it would still allow for a profit potential. not counting the profit that we're locking in. So that's another way where we could reduce our capital risk, right? That move would basically be a 24-cent premium back into our account. Or we could just look to close it, right? Didn't follow through, protect the remaining capital, and move on to the next trade idea. So we'll see if that can't follow through on Monday. Technically speaking, right, if this were not my challenge account, I'd probably wait again to see if maybe we couldn't follow through on this one. If it, doesn't tomorrow, if it doesn't Monday and then also follow through here, right? If it kind of hung out and it was still consolidating. In my main account, I'd probably still give that a bit more time to follow through just because it's a small capital risk. But in the challenge account, right, we still need to be mindful of our capital in that case. Overall, let's go to our account statement here. So here you can see all the trades that we've done so far for the year. Kind of makes it nice for the first challenge because it's very clean looking. But you can see here, right, we've had some nice profits, but currently CSCO and DKNG are certainly weighing down on those profits. And then, of course, with SPY and WBA being down, it's currently bringing down our overall year-to-date to a drawdown of 31.50. So the good thing here, right, is hopefully this is still teaching you all about risk. So you can see we're still not invested in the full $500 for the challenge, even though, we've taken some nice profits and we are currently also experiencing some losses. By controlling our risk, we're right now with a very minimal loss of $31.50, which to me could very easily be made up within the next week and still leave us positive. So that to me doesn't look bad. Now, the idea here is I would still like to take some sort of, ideally, right, I'd still like to take a few hundred out of the account. But this means maybe we need to look at some strategies that allow for still small risk, but a greater profit potential. So that way we could try and obtain that profit. So the one idea would be to look at something. We kind of already have the SPY trade on for the market. So let's go over to Tesla. Right, Tesla today into the close. It was so close to not closing above the 10-period simple. I've been looking at Tesla for the mastery account for my main account for some trade ideas here because I ultimately still am a big fan of Tesla. We have earnings coming up next week. So to me, we're either probably going to stay in this range or we're going to bounce higher into the news. And I do like that going into the close on Friday, right? Today, we at least tried to print a bullish divergent bar. What I wanted to see for me to put on a trade today was us close in a bullish divergent bar and hold the 10-period simple. And it literally wasn't until the last few minutes of market that we started to break and hold above the 10-period simple. So to me, it wasn't enough time to actually send out an alert, which means I'm just going to reevaluate this again on Monday, and maybe I miss out on part of the move if it really starts to shoot up. But that's okay. Still could allow us a profit. So what we could look at here for the challenge account on Tesla is consider jumping into a similar situation to what we have on SPY. Hold on, I'm just setting it up. 1 second, guys. So something like this, right? And we can always adjust these strikes depending on where we think it's going to move. But let's say we think it's going to get up to 875, right? That would just be slightly below the prior highs that we had back here in Tesla. So if we think it is going to see a run up into earnings, this might be the trade we consider. Once again, on a broken wing butterfly, right? It's the combination, in this case, of a 5-point debit spread and a 2.5 with credit spread. The idea here is if we go up to 875 and stall, right? Which keep in mind, I would not plan to hold this through the earnings announcement. And I've already priced this out to where the broken wing butterfly can still allow for a profit potential into the earnings announcement. And what I mean by that is much like we talked about theta decay, right? When a symbol goes into earnings and you're looking at an expiration that follows immediately after it, like this one does, right? So earnings is on the 27th and our expiration next week is the 29th. What happens is kind of the opposite. So typically when you go into an expiration, you experience that theta decay, right? The options lose value, especially the ones that are out of the money, the closer you get to that expiration date. When you have an expiration where it encompasses the earnings announcement, you actually see that intrinsic value build up into the options, even the ones that are out of the money. You actually see them typically start to increase in value, especially when it's a volatile symbol like Tesla. And the reason why is due to the uncertainty around that announcement, right? They're not sure if it's going to gap up or gap down wildly or if it's going to stay flat. But the anticipation of this news and the anticipation of that wider range possibility actually builds option value into the options. And then once the earnings announcement occurs, once the market digests the movement, then all of that value gets sucked back out of the options, and they're, back trading where they probably should have been to begin with, right? So because of that, doing spreads sometimes where you don't plan to hold it through earnings, but you're using an expiration that follows immediately after. When it's a narrow spread, sometimes it doesn't allow for that profit potential. But in the case of the broken wing butterfly, at least when I was pricing this out earlier today, this still allowed for profit potential because of how it's set up. So that benefits us, first of all, in the challenge. The idea here is that it's only a 96 cent cost basis, right? So it's under $1. Still well within our risk tolerance. Still wouldn't be our full capital risk invested currently. So all of that looks good to me. It has a 5-point width on the debit spread side of the trade and a 2.5 width on the credit spread side. So what this allows for is if Tesla moves up to 875 and stalls there, technically going into expiration, the max profit potential would be 404. So when I was pricing this out, I think it was around a $2 profit if we immediately start to go there at the money. Like the value of the trade was around $2. So certainly that would allow for a quick dollar profit to be locked in and put back into the account, right? And if it was greater than that, right, if it was $3, that'd be roughly a $2 profit, so on and so forth. If Tesla really explodes to the upside, right, let's say, it gaps open, news comes out that people like to hear or something like that, Elon Musk says something, tweets out something, and it gaps higher and moves to the upside, and all of a sudden the spread is in the money. Well, the benefit here is our credit spread is not the same width as the debit spread, so they're not canceling each other out. In this case, 250 of the debit spread is canceled out by the credit spread. So to find the remaining profit potential, we take the remainder width of the debit spread, which is 250. We minus it by the debit that we still paid for this trade, which is 96 cents. And we're left with a 154 profit potential. So that means if this trade were to be completely in the money by expiration, its value would leave us, right? Its value would be around 250, which means it would leave us with about $1.54 profit potential. So once again, both of those profits would be right around, if not above, 100% return ideally, right? And excellent risk versus reward. And of course, for our challenge account, right, that would bring us back up, right? That would, to me, would still look good going into the month. It would help take care of our drawdowns, still leave us profitable. And then, we could move on to a new trade idea. So that's one trade that we could consider, right? It does encompass the earnings. So, a little bit trickier, but a lot of these symbols, it's not uncommon to see a move higher into the announcement. So if we did get to follow through on the divergent bar, right, if we followed through the trend and the bounce up, that could allow us a quick profit prior to the news that we can take. So let's go over to Amazon really quickly. Amazon's another one that, because of the volatility, can allow for some really great risk versus reward on a trade. So Thursday, right, we popped up going into the ATR trailing stop. That's still holding as resistance. Friday, weren't able to break above it. That's not uncommon. Tesla's, not too surprising to see it sell off a bit on a Friday. It doesn't have to be a very strong sell-off, but you can even see here right? Compared to the close of yesterday, we technically closed lower, right? And that's just something I've certainly learned over time trading Amazon is on the weekly expirations, or on the monthly, that Friday, even if it had, a beautiful run up, it's not surprising to see it pull back a bit on a Friday. Sometimes it doesn't, but most of the time that's been my experience at least. So what are we seeing? Well, we're definitely consolidating our moving averages, though the 10 and 30 are starting to point up. So it's trying to go into a bullish trend. It's just not there yet. We're also attempting the bullish trend on the momentum in the compound breakout tool. Here, earnings is not next week, but the following week. So that's going to benefit us if we want to put on a trade for next week going into the end of the month. Bollinger Bands are opening up, so they're starting to anticipate a move higher. But we saw a similar situation back here where the price forced those Bollinger Bands to flare open, but resistance still held. Bollinger Bands flattened back out, and then it pulled back. The difference here is the price was trading outside the Bollinger Bands. It was really forcing them to flare open. Here, the price just barely traded outside the Bollinger Bands intraday, but the Bollinger Bands, once again, are still feeling the need to flare open. So that, to me, is a little bit stronger of a sign. However, I would personally prefer to see us break the ATR trailing stop before jumping into necessarily a bullish trade here. So let's price out two different things on Amazon, and then we can certainly see how it goes into Monday. Before, we could even wait till midweek probably before putting on a trade on ID on Amazon and still benefiting from the risk versus reward. But let's say we think it's going to break above it and it's going to continue higher, and it too will see a run into the earnings announcement. So if we wanted to do something like a standard butterfly, we could go with a 3,400 pin, right? Nice psychological level. About 1,000 point higher, which for Amazon's not too surprising. We've also gone up to 3,500, so we might want to be mindful about that. But we could do just a standard butterfly. That's going to be the cheapest on the risk versus reward. So if we did something like 30 points, let's start there and then we'll narrow it. So yeah, 30 points is $1.84. For my main account, that's no problem. Allows for a 28.16 profit potential. But for the challenge account, I still think I'd want smaller risk than that. So here's what would make sense, right? A 20 point width spread. So here, it's a 90-cent cost basis, right? Still within our risk tolerance for the account. Still not the full account that we're investing or anything like that. But it allows for a $19.10 profit potential. So an excellent risk versus reward there. So certainly, right, if we did get that pin around 3,400 going into the end of next week, I wouldn't hold for that max profit potential because I don't want to have the risk of assignment. But that would certainly look great for our challenge for the first month, right? If we got that full profit there, well above 100% return on the capital of the entire account. So wouldn't mind that. But let's say we're concerned about that bullish sentiment, right? What if it goes up to 3,500? Well, if this is completely in the money as a standard fly, it wouldn't be profitable, right? It would still encompass that loss. So instead, let's narrow this down and consider doing something like this, right? This still isn't a bad risk versus reward. The reason why I brought it in is just to bring down our costs between doing a 10 point width spread here and a 15. Well, that doesn't look too bad actually. So we could do this. It's a little bit more, but it's $1.25 versus the 90, so it's about $35 more in the cost. But it allows for a bit better max profit potential. So if Amazon does go up to 3,400, like we're intending it to next week, right? If we see the bullish sentiment, if we're breaking resistance and we're like, yeah, this is definitely going to take off to 3,400, then it's a $1.25 cost basis, but a 3,400 pin allows for a $13.75 profit potential because it's the 15 point width on this side minus the cost basis, right? That's our max profit potential. So once again, excellent risk versus reward. If though Amazon just completely shoots up and let's say goes to 3,500, right? Then our spread's completely in the money. But once again, because the credit spread is a smaller width than the debit spread, it still allows for a profit. So in this case, right, 15 points minus 10 points means the difference is 5. 5 minus $1.25 is a $3.75 profit potential. So still not a bad profit potential versus the risk. So I actually kind of like that if we get that bullish sentiment higher. Does mean we have a ways to go to the upside. So we could always bring this down if we don't mind it going in the money, right? So instead of doing 3,400, maybe we do 3,450 or 3,350, I mean. And if we kept it, yeah, so that doesn't look too bad. That's pricing it at about 95 cents, a little bit wider on the bid and ask. So, something to be mindful of. But if you could get that fill, once again, excellent risk versus reward. And if it does completely end in the money, you're still walking away with a profit. So Spine Chief, the reason why I don't make the credit spread the same width here as the debit spread is the forgiveness factor if I really think Amazon is going to explode higher. So if they're the same width, right, it's definitely a lot cheaper. But if this trade ends completely in the money, meaning Amazon, let's say, is at 34 or 3,500, which means all these strikes are in the money, I'm still going to end up with a loss here. But by making the credit spread more narrow, it still is much cheaper than jumping into a straight 15-point debit spread at this level, right? It's 95 cents versus 405, right? So it's much cheaper than just a straight vertical. So it protects on the risk in that case. But it still allows for profit potential if Amazon does explode to the upside. So if it doesn't go where we think it's going to pin but shoots higher, and this does end once again completely in the money, it still allows for that profit potential on the trade. So that's why in this case we might consider making it a broken wing butterfly, which is what this is called, versus just a standard butterfly. So I kind of like this one. If we could get filled at 95 cents, this to me makes a lot of sense. And of course, I'd want to see the break in the ATR trailing stop. But Amazon's no stranger to a 100-point move within a day, so it wouldn't take too much to get up to this level, or certainly to break above this level, which once again, in either way, is still going to allow us to be able to lock in a nice profit. So those are trades that we could look at for the challenge account come next week. So that's certainly something to keep an eye on. Vice versa, if we think it's going to move lower, we could look at the same thing but to the put side and maybe do, not what I wanted. There we go. And maybe do a pen around the moving averages back here around 32 to 31.80. So similar situation, right? Maybe we do 3,200 as the pin, but we give it a buffer zone in case it goes to 31.80 or tanks all the way potentially down to 3,100 again, right? Which if the market's selling off, that could very well be the case. So a little bit more expensive on this side as of right now, actually. So it looks like, sometimes when it's more expensive, that's what the market makers are anticipating, right? So they're trying to make you pay more. But similar situation, 15-point width on the debit spread, 10-point on the credit spread. It's $1.54. So if we do go down to 3,200 and stall there at that nice psychological level, it's a max profit potential of 13.46. If we completely break to the downside to go to 31.80 or lower, right, and this spread is completely in the money, it still allows us a $3.46 profit potential based on our cost basis. So once again, not a bad risk versus reward there. So yeah, I like those, actually. I'm glad we did this tonight, because I didn't think about looking at it on Amazon, but that's a nice cost basis versus the risk, and still allows for some forgiveness factor to the trade if it really takes off one direction or the other, and still allows for a nice profit potential even if that were to occur. So it's kind of what I'm leaning towards right now for next week. And then that way ideally, right, if it works out, takes care of the drawdowns, still allows us a profit, it protects our prior profits, and we'll still be able to pay ourselves at the end of the month. And if not, right, then we'll chuck it up to a loss, and we'll start fresh next month with the new $500, and ideally keep it up with what we had last year, which were 2 profitable months back to back. So thank you guys for joining me. I appreciate you all being here tonight. And of course, if you're not here but listening to the recording, thanks for that as well. But it was fun talking with y'all in chat. I hope you guys have a great rest of your day, if you're still going to stay up, or a wonderful and safe weekend. And then we'll be looking at for fresh trades on Monday. And then we'll, of course, do another update like this on Friday, which will be kind of perfect because it will be the last trading day of the month. So we can round out how the challenge did for January, really walk through each of the trades, and then prep ourselves for some new trade ideas for the next month. So have a great night, y'all, and I'll talk to you ideally on Monday, right? Bye.